Many professionals think ESOPs don't cost the company anything because no cash goes out, but that is completely wrong. Ind AS 102 ensures that value of the employee stock compensation is properly recognized in the books. In this video, I will explain the full concept with practical examples and journal entries so that you never get confused again. So we are here to present the complete details on Ind AS 102, which is share-based payment. The key topics that we are going to cover today so that you'll get adequate understanding of the concept and you could able to clearly articulate the concept of ESOPs and RSU. Topics that we're going to cover today are objective and the scope, types of the share-based payment, core recognition principle, what are the measurement principle, concept of equity settled share-based payment, what are the vesting conditions, what is the concept of cash settled share-based payment, share-based payment with the cash alternatives, what will happen if there are modification of the share-based payment, cancellation of the or the settlement, and then what is the treatment of group share-based payment transaction. Then finally, we are going to cover the presentation and disclosure, followed by the comparison with IFRS 2. So if you're watching this video, you're clearly serious about mastering Ind AS. Comment 102 done, so I know you want the next standard explained. So let's move to the first slide then. Okay, so we'll quickly talk about the objective and the scope of Ind AS 102. So objective of Ind AS 102 is to specify the financial reporting requirement for the share-based payment transaction, ensuring that the cost of the equity settled in the cash settled share-based payments is recognized. The value of the goods or services are received as reflected in the financial statements. Economic cost of the employee compensation is not applies even if no cash outflows occurs. So very typical case wherein we are saying that it's economic cost of the employees, which means that we are issuing the share to the employees basis the economic cost that they're going to serve us over a period of time, which is largely the vesting period, and we're going to talk about that in detail in the upcoming slide. So objective of Ind AS 102 is to make sure that any kind of the payment which is being settled equity or which is settled as a part of the equity but not directly in equity but in lieu of the equity it is settled in cash. So all those payments would should properly reflect in the financial statements. The necessary accounting entries properly done, and to make sure that at each reporting date the recognition is as per the requirement of the Ind AS 102. Now, when we look at the scope here, this scope is it applies to the employee stock option plans, ESOPs. It applies to the restricted stock unit, which is RSU and restricted shares, share appreciation rights, share-based payment to vendors, the consultants, group share-based payment arrangement, and the performance shares. What it excludes is issue of the share in cash, which is like normal issue of the shares, and business combinations covered. So basically, during the acquisitions, when we are issuing the shares, so that is basically a different treatment altogether. So Ind AS 102 applies to all the transactions where an entity receives goods or services in exchange for the equity instruments or the cash amount based on the entity's equity share price, including the employees and non-employee share-based payments. So basically, all the payments which is being done, and in lieu of that, either equity share has been issued or a cash amount based on the entity's share price has been given. That is being treated under the Ind AS 102. So we'll move to the next slide and look at the further details. Okay, now we'll talk about the type of the share-based payment. So typically there are three type of the share-based payment. One is the equity settled when we are issuing the equity in lieu of the transaction. So basically entity issues own equity instruments. The company does not pay the cash. It pays through the shares or the equity instruments. Second is the cash settled. So entity pays cash based on the share price. Basically what we have to do, we have to create a liability. Expense is recognized over the vesting period. Liability is remeasured at the fair value at each reporting date. So in the case of equity, it is not remeasured at each reporting date. Once it has been recorded at a fair value on the grant date, it will carry the same amount. it is not going to get remeasured. But if it is being cash settled, wherein entity pays cash based on the share price, then it is going to get remeasured at each reporting date. And at the each reporting date, it has to either increase the liability or decrease the liability basis on the fair value. Third is share-based payment with cash alternatives. So basically, it is a kind of a situation wherein choice has been given. Either employee has the choice or employer has the choice. Instead of being settled in equity, it can be settled in cash. So choice of settlement is there, either to the entity or to the counterparty, which is the employee or the vendor. So employee has a choice if to get the equity or cash. In that case, it has to be treated as a compound financial instrument, wherein part is treated as an equity and part is treated as a liability, which means that for equity portion, the fair value is not going to remeasure on each reporting date, but for the liability portion or the cash portion, it is going to get remeasured at the each reporting date. If company has the choice, which is like equity or the cash, then treat it based on the expected settlement. So if company wants to settle that amount on the cash basis, then it has to create a liability which will be remeasured at each reporting date. But if it is equity, then there is no remeasurement. It is like the fair value that has been recorded on the grant date that will be carry over the vesting period. So three type of share-based payment: equity settled, cash settled, and finally share-based payment with cash alternatives. So we'll move to the next slide. Okay, now we'll quickly talk about the core recognition principle of Ind AS 102. The entity shall recognize the goods or services received in the share-based payment transaction when the entity obtained those goods or services, the services rendered by them. So which means that we have to record the value of the services when we received, and then we have to also create either a liability if it is being settlement through cash, or we have to create a reserve, equity reserve, if it is being settled through equity. So if it type of transaction is employee services, they recognize as an employee compensation expense. If it is good received, it has to be recognized as an asset, inventory, PPE, or intangibles. If it is vendor services, expense or asset, and if it is group share awards, it is to be treated as an expense in the subsidiaries. The recognition is depending upon the type of the settlement. If it is equity settled, then expense to equity reserve. If it is cash settled, then expense to liability. And if it is a choice of settlement, then we have to do the expense or split between the equity and the liability if it is being choice by the employee. But if it is a choice by the employer, then the intention at which it is to be done, whether it is a cash or it is to equity, will decide the accounting entry. So expenses are always recognized over the vesting period, and the credit depends on the nature of the settlement. Equity settled, then equity would be credited, but if it is cash settled, then we have to create the liability, and then this liability is going to remeasured at each reporting date, and any increase or decrease in the liability would be charged to my P&L, not to equity, because this is not a equity, it's a liability that has been created. So any increase or decrease on the remeasurement will directly charge to my profit and loss account. So we'll move to the next slide. Okay, now in this slide, we're going to speak about the measurement principles. So we have understood the concept of recognition principle. Now we are going to talk about the measurement principle that typically helps us to understand the value at which accounting entry would happen. So employee share-based payment, the fair value of the equity instrument at the grant date, this is most important. So equity instrument at a grant date, and non-employee share-based payment is largely the fair value of the goods or services received. So we'll understand more this with the help of example. So equity settled transaction measurement rules. Measurement at the grant date or the fair value. Do not remeasure subsequently. Recognize over the vesting period. For example, company grants 1,000 ESOPs. Grant date fair value is 50 per option. Total fair value is 50 into 1,000, which is 50,000. So we have to recognize the expense over the vesting period. For cash settled transaction, measurement rule is that measure at the fair value of the liability, remeasure at each reporting date until the settlement, recognizes changing in the fair value in the profit and loss, as we have discussed in the last slide. Company grants uh, share appreciation rights worth rupees 1 lakh, and year end FV become 1,20,000. So increase of 20,000 will be recognized in the P&L. This table quickly explain the measurement criteria for equity, cash, and the choice of settlement, all the three types. So if it is equity settled, the fair value is the grant date, remeasurement is not allowed, credit to equity. If it is cash settled, fair value at the reporting date, remeasurement is allowed and credit to the liability, and choice of settlement split between the equity and liability, and it depends, and then credit has to be either equity or the liability, whatever the choice would be. So for ESOP and share options, fair value of the option at the grant date. For RSU, fair value of the share at the grant date. For SAR, which is cash settled, fair value of liability at each reporting date. For performance share, fair value adjusted for the non-market condition. And for equity to vendor, fair value of the services or the goods and services. So there are two conditions: market condition and non-market condition. We'll talk about that both these conditions in the next slide. So measurement principle is very simple. It simply says that if you are doing the settlement in equity, then we have to measure the equity at the fair value on the grant date, no remeasurement on the subsequent reporting date, and hence it has to be done over the vesting period in case of the equity is being granted to the employee in form of the RSU or in the form of ESOPs. But in the case of cash, if it is settled through in cash, then definitely it has to be treated as a liability, and which remeasurement is going to happen on each reporting date at fair value, and then any increase or decrease would be charged to the P&L. So we'll move to the next slide. Okay, now we are going to explain this concept of equity settled share-based payment with examples. So let's just have a look at the example so that we are absolutely clear that how this accounting happens. So key rules are fair value measured once at the grant date, not remeasured subsequently. So again, I'm reiterating the points. It has to be only once, and there is no subsequent remeasurement. The accounting happens basis the vesting period, expense paid over the vesting period. So example one, which is like basic ESOPs, option granted of 1000, fair value at the option date is 50, vesting period is 4 year, expected vesting is 100%. Total compensation cost is 1000 multiplied by 50, which is 50,000, because it is 4 year, and hence we have to do the accounting of 12,500, which is like 50,000 divided by 4. So at each year we have to do the accounting employee compensation expense, and credit would be to my equity ESOP reserve. So in case of second example, now we have taken the example of RSUs, which is restricted stock units. So RSU granted is 1000 share. Vesting is again 4 years, which is 25% each year. Exit clause, if employee leaves, only completed years completed year vest, and then employee leaves after. So this we are saying that in this case employee left after 2.5 year. Fair value at the date of grant was 50 rupees, and the fair value at the year end, which is like year one and year two, is 60 and 70, and year three is 80. So how we are going to deal with this? We are going to go to next slide and see, because see again this typical example is there to confuse us, because what it is saying that we have a value of at the fair value at the end of the year one, year two, and year three, but principle of equity settled share-based payment is that it cannot be remeasured subsequently. These kind of examples helps us to understand this in detail, and also when these kind of questions come, we should not get confused, because the fair valuation is allowed only at the time of the grant and not at the subsequent date. So we'll look at the how this example is going to get resolved in the next slide. So we'll move to the next slide then. Okay, so we'll now quickly understand this example. So we know that there's a clause wherein we have RSU and the vesting period is 4 year. Employee leave the organization after 2.5 year. How we have to do the accounting entry? So first of all, we have to calculate the total compensation cost. So 1000 is the total RSUs and the fair value is 50. So total value, which is 50,000, this is recognized over the vesting period based on the expected share vest. So year one entry would be 12,500, which is like divided by 4. Year two entry will also be the same. There's no change, which means that expenses got recognized in year one and year two. And then employee leaves, which means that employee has left the organization. So there is no recognition in the third year, because employee has not fulfilled the condition for the vesting, and hence nothing would be recognized here. Total expense recognized would be 25,000. This would remain as it is. There is no reversal happen because whatever amount has been vested for that employee has already rendered these services. So which means that even if the employee has left these services without completing the vesting period, the amount which has already been recognized is not going to get reversed. This is going to get carried as it is. So when is the expense recognized? At the end of the each accounting period. As the employee renders the services during the vesting period, recognition is spread over the vesting period. We have discussed this earlier as well. At what value is it to recognize? At the fair value at the grant date, not at the fair value at the year end for equity settled and the share-based payment. Grant date, fair value is locked and never revision. So which means that the value which has been given at the end of the year 1, year 2 and year 3, that is not going to solve any purpose, or it's just for information purpose. It's not going to impact the valuation at which the ESOP or the RSU would be recorded in the books of account. And most important point is that once it has been recognized, we cannot do any reversal of the entry which is there, because that for that particular period the employee has already rendered the services. So we need to again typically understand the concept of Ind AS 102. It is not the expenses that we are accounting, it is the services or the fair value of the economic benefit of the services which the employee has granted us, that is being getting accounted here. An employee has provided their services for 2 years, and hence we have to recognize the equivalent employee cost, and then we have to credit our ESOP reserves. And after vesting period, if the employee exit and no vesting has been done because the conditions are not met, then this amount which is there in the ESOP reserve would then be transferred to the retained earning. This is the policy of the company. So we'll move to the next slide. Okay, now we'll talk about the vesting condition, and we're also going to talk about the two condition, market condition and non-market condition, which we discussed in the earlier slide. We're going to have a detailed understanding of this as well with the example. So vesting conditions are first is service condition. So when we talk about vesting, which means that we are saying that employee must complete a certain period of services, then only he is entitled to that particular RSU or the ESOPs. Performance conditions are market condition, which is share price target, and non-market conditions, which is like profit, sales, and EPS. So if performance conditions are market conditions, then share price must, let's say for example, we are saying that typical examples would be share price must reach 500, company total shareholders return must exceed the industry average, or stock price must grow by 20% on the CAGR basis. A non-market condition can be EBITDA must be exceed 100 crore, profit after tax must grow by 50%. So these are like conditions basis which the equity or the cash equivalent to the equity would be given if these conditions are met. Some are market conditions, some are non-market condition. But the impact on the fair value and the treatment would be different if it is a market condition and if it is a non-market condition. So if it is a condition which is a market condition, then impact on the fair value is already included in the fair value, and there is no revision on the number of the options or the number of the grants that needs to be given. But if it is non-market condition, it is excluded from the fair value, and hence it revised the vesting estimate. So which means that the vesting amount would vary if at all there is a change in the non-market condition. So we have illustrated with this with the help of the example here. If it is non-market condition, let's say option vest only if profit exceeds 10 crore. Later expectations only 80% employees will meet this condition. Expense recognized based on the expected vesting option. So which means that our accounting is going to happen basis the 80% of the total vesting amount that is going to get accounted for. So which means that non-market condition is going to have the impact on the fair value because the impact was not included at the time of giving the grant. But in the case of the market conditions, it is the impact on the fair value is already included, and hence there is no revision in the valuation of the fair value. So this is the treatment when vesting conditions are there. And as we understood that two type of conditions are there for vesting condition, which is service conditions and the performance condition. And within performance, it is market condition, non-market condition. Market condition, no revision in the fair value, and non-market condition, it has the revision because the impact of the on the non-market condition is going to have direct impact on the fair value at which the grant was being granted. So we'll move to the next slide. Okay, now we have looked at in detail. If the payment is being settled in the equity, what is the treatment? We are going to spend some time in understanding that if it is being not done through equity and if it is done through cash settled share-based payment, then what is the accounting treatment? So whenever we are doing any settlement which is basis the cash settled share-based payment, key rule is that it has to be recognized as a liability. That is most important. It has to be measured the fair value, and then at each reporting date, remeasurement needs to be required. Example, SAR share appreciation right. SAR granted at 500. Fair value of the SAR at the year end is 100. Vesting completed. So employee compensation expense to share-based liability, because this is not equity, this is a settled in cash, and hence we have to create a share-based payment liability, and liability updated every year till the settlement, and any increase or decrease in the liability will be charged to my profit and loss account. This is the treatment whenever we are doing the cash settled share-based payment. So we'll move to the next slide. Okay. So we are going to talk about the third option here, which is share-based payment with the cash alternatives. So we have talked about the equity share issues. We have talked about the cash settled in lieu of the equity, and now we are saying that share-based payment with the cash alternatives. So if employee chooses, we have to treat it as a compound instrument. We have discussed this earlier. And if employer chooses, then it has to be expected settlement. Now we are going to take an example for employee option. If employee chooses, then it has to be separated into the equity and the liability. So example, company grants 1,000 shares at the grant value of 100. Cash alternative fair value is 80 per option. Total fair value is 1 lakh. Liability component is 1,000 multiplied by the 80, which is the cash alternative for the fair value, and equity component is balancing figure, which is 20,000. So employee compensation expense would be debited with 1 lakh. The liability would be created for 80,000, and equity ESOP reserve would be created for 20,000. This is called a compound instrument. Equity portion remains unchanged. However, liability portion is going to get remeasured at each reporting. We have discussed this in previous slides multiple times. Now, if it is entity chooses, so company grants 1,000 RSU, grant date fair value is 100 per RSU. Company has the right to settle in cash instead of shares. So company intends to settle in shares, but company has now opted for which method? Intended in shares. So which means that accounting treatment would be the cost would be debited and my equity RSU reserve will be credited. It's not a liability because company has chosen to settle that amount in the shares. So when the employee has the option to choose between the cash and the equity settlement, the arrangement is treated as a compound financial instrument with both the liability and the equity components. When the entity has the option, the arrangement is accounted for in either of equity settle or the cash settle based on the expected method of the settlement. So this is a thumb rule, and we have discussed this in the previous slides as well. So wherever the choice is being given and the choice is being given to the employee, then it has to be treated as a compound financial instrument. But if it is at the employer, then the way employer is going to get it settled, that will largely treat the accounting for that particular equity or the cash settlement. So we'll move to the next slide. Okay, now we'll discuss about the modification of the share-based payments, which means that modification of the terms and the condition basis which the grant has been given to the employee. So modification occur when the entity changes the terms and the condition of the share-based payment arrangement after it has been granted. So which means that it can be either the change in the exercise price, extension of the vesting period, increase in the number of the share options, or change from the equity settled to the cash settled. So any kind of changes will treated as the modification on the share-based payment. Then how we have to treat this modification? If modification increases the fair value of the benefit, recognize the increment fair value. So which means that on the date of modification, if there is a increase in the fair value, then we have to do the recognition of that increase in the fair value. If modification reduces the fair value benefit, then we have to ignore the reduction. This is a simple thumb. So which means that, and this is largely is aligned with the basic principle, because if it is equity settled, then we have to do the measurement only once we have granted. We cannot do the remeasurement. But in the modification, it is a situation wherein we are actually doing the modification, and then it requires the remeasurement, but remeasurement is allowed on the upward only, wherein we can do the remeasurement basis the increase in the fair value. Any decrease will not be treated as, because then it will go back to the original grant date at which it was locked. So we cannot reduce the recognition of the expense. This is the reduction in the fair value at the subsequent date, provided that if the modification has happened at the subsequent date. So thumb rule is simple. Whenever modification happens and if it increase the fair value, then we have to do the adjustment in the entries. But if it is decrease in the fair value, then it does not require any reduction and we have to ignore that reduction. Okay, now we'll quickly talk about the cancellation and settlement. So we'll first talk about the cancellation. So what is the meaning of cancellation? So cancellation means then the entity withdraws or cancels the share-based payment arrangement or scheme is terminated before vesting. So which means that cancellation is being done by the company. And whenever these kind of cancellations happen, it is assumed that the vesting has been done by the employee, and hence we have to do the full recognition of the employee cost in that case. So which means that if at all, after we have a example wherein the vesting period was 4 years, and after 2 years the entity does the cancellation, then what is the treatment? We have to recognize the remaining unrecognized expense immediately. So example, company grants 1000 ESOPs. Fair value at the grant date was 100 per option. Vesting period was 4 years. After 2 years, company cancels the scheme. So expenses recognized in the first 2 years is 50,000. Unrecognized portion is 50,000. So whenever this cancellation happen, we have to recognize this another 50,000 immediately in that year. So it would be again employee compensation expense to the ESOP, to the equity ESOPs, and no reversal of the already recognized expense, because that amount has already been provided as a part of service by the employee. But situation would be different when the cancellation is because of the any issue from the employee, in which case that if let's say employee has not completed the vesting period and he has exited the organization, then what we have to done, so if employee forfeiture is done, for example the shares were issued but forfeited because the employee has not met the vested condition, then what happens, then if employee failed, award not earned, so reverse the unvested cost. So if at all it has been accounted for as amount of the unvested cost, then it has to be reversed. There is no reversal of already recognized cost. This is a thumb rule, because it is assumed that employee has rendered the services for those years for which the expense has been recognized. And most importantly, whenever cancellation happen because from the entity side, then in that case we have to immediately recognize the unvested portion in the year in which cancellation happens. So this is the treatment whenever we do the cancellation. Now we'll move to the next slide to understand what happened when we do the settlement. Okay, now we'll talk about the settlement. So settlement means when the entity pays cash or equity to settle the share-based payment arrangement early, and the settlement is treated as a cancellation for the accounting purpose. So treatment is same. So company grants 1000 ESOPs. Fair value at the grant date is 100 per option. Vesting period is 4 years. After 2 years, company settle the amount for cash for 70,000. So what we have to do? So expenses recognized in the first 2 years is 50,000. On cancellation, remaining expenses 50,000. So recognize that immediately. So employee compensation expense would be recognized with 50,000 and equity would be credited with 50,000. And then what we have to do, no reversal of the already recognized expense. This is a thumb rule. We have discussed that. But what has happened that if the settlement is payment exceeds the ESOP reserves, then excess goes to the P&L. What we have to do, because this settlement is now is going to get done in the cash. So whatever ESOPs we have already created, we have to debit that ESOP reserve would be debited and bank would be credited with the amount that has been paid. So there is a net gain which is going to the retained earning, which is like 50,000, 20,000, which is 70,000 minus 50,000. And the thumb rule is that if settlement payment exceeds the ESOP reserve, then excess goes to the P&L. So which means that the charge would be to my P&L if at all the amount which is going to get settled is more than the amount that exists in the ESOP reserve. But if the amount in the ESOP reserve is more and the settlement is less, then obviously the balance amount which is in the ESOP reserve is going to get to transfer into retained earning, and that's a largely part of the equity. So this is the treatment for the settlement whenever settlement happens before the actual vesting period. So we'll move to the next slide then. Okay, now we'll talk about the group share-based payment transaction. So when we talk about the group share-based transaction, it largely means what? A parent company grants equity instruments like ESOP, RSU, and SAR to the employee of his subsidiary, or a group entity settles the share-based payment on behalf of the another group entity. So thumb rule is simple. Wherever the employee exists or wherever the employee has provided the services, in that entity we have to recognize the cost or the expense, and the entity which is issued the shares, in that entity we have to create the ESOP reserves or the equity reserves. So if even if the subsidiary does not issue the share, it must still recognize the employee compensation expense. The subsidiary receives the employee services even though the parent provide the equity instruments. So the expense must be recognized where the services is rendered. So example, parent issues the ESOP to the subsidiary employees. Parent grant 1000 ESOPs to the employee at the fair valuation of 100, vesting period is 4 years. So subsidiary at the end of each accounting year would pass the entry as employee compensation expense with the credit to the equity, which is capital contribution from the parent. And then parent would pass an entry, which is investment in subsidiary, to the ESOP reserves, which is like this reserve would be created in the parent, and the expense recognition is going to happen in the books of subsidiary. So this is a example whenever the group share-based payment transaction happens between the parent and a subsidiary. So we'll move to the next slide to understand the presentation and disclosure. Okay, so we have come to the second last slide of this presentation on Ind AS 102. So presentation, how we have to present. So if it is equity settled, we have to show credit to the as other equity, and if it is liability cash settled, then we have to show liability under the financial liabilities. As far as disclosures are concerned, we have to disclose the nature and the terms of the arrangement, number of the option outstanding, granted, exercise lapsed, and fair value assumption, and then the expenses recognized during the period. So all these needs to be disclosed as a part of the disclosure requirement of Ind AS 102. So we'll move to the next slide, which speaks about the differences between Ind AS 102 and the IFRS 2, and understand if there are any differences. Now, when we compare the Ind AS 102 with IFRS 2, largely it is same. There is no conceptual differences. It is largely converged and in line with the IFRS 2. So we'll move to the final thank you slide then. Okay. So this was the complete understanding of Ind AS 102 share-based payment. We covered the objective, scope, type of the awards, measurement, vesting conditions, modifications, cancellations, and group transaction with practical accounting example. So if you have understood this standard, you can confidently handle ESOP, RSU, SAR, accounting both in exam and in real corporate reporting. Thank you for your time, and I look forward to bringing the next Ind AS in our series. Thank you and goodbye.